Hi everyone, Donna here. I'm the owner here at Bookkeeping Made Simple. I want to talk a little bit about cash flow today because I have seen business owners make this very classic mistake. So they look at the profit and loss, they look all the way down at the bottom line, they see that there's a positive number there, and then they assume that that money is available to be withdrawn from the business. Or they can't figure out why they have no money in the bank. Now, typically, the reason this happens is because they have liabilities. Now, remember, liabilities don't show up on the profit and loss. They show up on the balance sheet. Okay, so they have liabilities that they have to then pay on, they have to fund, and they don't realize that that impacts their cash flow negatively. Okay, so an example of this would be, I have had a client. He hasn't been a client for a little bit, so I am going to pick on him a bit. He would borrow money from various, basically payday loans for business. Cabbage is one. He would borrow money, big interest rates, large payments, and a big balloon payment at the end. So he would borrow this money and he would use it for operating expenses. This wasn't money he was borrowing to fund equipment. It wasn't money he was using to fund expansion. Honestly, once your business is established, you should never need to borrow capital because your business should be cash flowing enough that you don't need to. Okay, and he had an old established business. He was young. He was himself new to the business, but it was an older established business. They had solid profits. They had solid revenues, and he would make poor decisions, not follow. I mean, they could have been good decisions. Okay, one was to open a second location, and then he kind of stepped back from that, and instead of using this new location, which would have allowed him to about quadruple his revenues if he had done it correctly, he got scared and didn't really commit. Okay, so he has these two locations. One can serve X number of customers at a time. The other one can serve 3 times as many. And he didn't want to run either of them as a viable business. So what happened then was he had all these expenditures related to the second location, no revenue coming in from the second location. And then he was taking out loans to fund ongoing operations. Okay. Now, my philosophy on that is I'm huge on, yes, you should definitely leverage your money whenever possible. Okay. So if you are expanding, which is what he started doing, when you're expanding and you need to buy equipment, or you need to buy additional properties, or you need to buy more supplies. If you're expanding, then I consider it reasonable to borrow money to cover that. I do not consider it reasonable to have a business that cash flows $20,000 or $30,000 a month and then take out loans to cover operating expenses. That just doesn't make sense to me. And I would warn them. I would tell them, you're profitable, but your cash flow is negative, and you cannot continue to run a business for very long with a negative cash flow. Never could get them to understand what I meant. It was 2 brothers. Never could get them to understand what I meant, especially the one brother that took over finally. I just couldn't get him to understand that cash flow and profits are 2 different things. So profits are, you take your revenues, you take your cost of goods sold, you subtract that from your gross revenues, that gives you your gross profit. That's what you made after what you had to spend, So for example, I have a bookkeeping company. My profit depends on how well my bookkeepers do the books for my clients, right? So my gross profit is my gross revenues minus the cost for my bookkeepers. And that's my gross profit. Now I have more expenses though. These are more overhead expenses. Okay, so this is what it costs me to keep the business open. This is rent, utilities, dues and subscriptions. So that's softwares. The software that I pay for my clients is more of a, it's directly tied to the clients, but software that I pay for my clients, software that I pay for just to be able to run my business, internet connections for myself. If we had an office, we were looking into that. It would be, the office rent, administrative staff, but that these expenses also go on the profit and loss. And some businesses actually won't have a cost of goods sold. They will just have their gross revenues minus their expenses, and that will show their bottom line. Outside of tax preparation, the reason to split that out, by the way, is to make it clear to the reader of the report what it is that we're looking at. And in a tax situation, well, we can make those determinations. So your bottom line then is your revenue minus your expenses, basically. Or your revenue minus your cost of goods minus your expenses. And that will leave you with hopefully a positive number at the end of the month. Now, that just means that your revenue minus your expenses was a positive number. It does not mean that money is available for you to invest elsewhere. Now we have to take a look at the balance sheet. So the balance sheet is a listing of your assets and liabilities and equity. Okay, assets are checking accounts with money in them, cash and cash equivalents. So that's any bank accounts with money in them, any properties held by the business. So if the business owns cars, equipment, real estate, anything like that shows in the asset portion. Okay. And it's important to have all of this information here. We need to know when you buy it. We need to know when you sell it. We need to know what you bought it for, what you sold it for, because what you bought it for is the basis for capital gains. And I'm going to have to do another video right after this one explaining capital gains. Okay. So we need to know what all of your assets are. Many of my clients will neglect to tell me, well, I bought, $5,000 worth of equipment for my business. I bought furniture for my office. I bought, whatever it is. We need to know. We need to have that on the balance sheet, because that's going to affect how your taxes are being paid. It's going to affect what happens when you sell a piece of property. It's going to affect actually quite a lot of things. Okay, we also need to know about all of your liabilities. Okay, this is where a lot of clients get very, very mixed up. Okay, so liabilities are credit cards, lines of credit, trade lines. A trade line is if you're a building supply, if you build homes for a living and you buy your stuff at Home Depot and you have a Home Depot card that you use just for that, that's a trade line. Okay. You put all of your stuff on account at Home Depot. At the end of the month, you pay off the card. That's a trade line. Okay. Another example would be if you're an auto mechanic and you have a line of credit at O'Reilly's. And so you go in and you tell them, I just want to put this on account. At the end of the month, you have to settle your account. That's also a trade line. Okay, we have to reconcile all of them. We have to make sure that that everything is as it should be. And we need to make sure that that you're not over or underpaying. So those are trade lines. We also want to know about mortgages. Okay, because your asset of an office building may be and probably is offset by the liability of a mortgage. Okay. We need to know about the date that you made these purchases, because that affects how well we can depreciate the asset, which means that you extend the expense of your asset over anywhere from 5 to 30 years, as opposed to expensing it all at once, which doesn't really match the revenues. And I want to talk about revenue matching in a different video. I will talk about generally accepted accounting principles. I have a long list of things I want to talk about. So yeah, so that's kind of it. So with the cash flow, what we need to know, well, let me kind of describe it in terms of a household income. Okay, let's say that I make $5,000 a month for easy math, and let's say that my housing bill is $1,500. That's rent. Okay, so that leaves me $3,500. Let's say I have a $100 electric bill, $3,400 left. I have a $100 gas bill, that leaves me $33. I have a $150 cable bill for my internet. I have, let's say I spent $500 that month on clothes. So that puts me down to about $2,750. Okay. Let's say we eat out a lot and we spend $1,000 that month eating out. Now I have $1,750. Okay. Let's stop there. I have $1,750 in discretionary income, allegedly. But wait, I have credit card payments, and they are $1,800 a month. Okay, so now my cash flow is actually negative. You won't see that in the profit and loss, because remember, the credit cards go on the balance sheet, so you won't see that. I have to make my credit card payments, or I have to make my car payment. You don't see that on the profit and loss, because car loan payments are not included on the profit and loss, they're included on the balance sheet. And so I can look at that and go, oh, I have $1,700 that I can spend. No, I don't. I had to pay on my liabilities before I can spend anything. I'm negative $100. So it's the same thing in business. Okay, so we think about it more in a household income thing. We'll tally up our credit card bills and our utilities and our housing and our miscellaneous other. And a lot of householders have very few expenses, but a lot of liabilities that they're managing. Okay, so that's, again, I'm going to go back over it. That's mortgages, credit cards, HELOCs, home equity line of credit. That's any sort of loan. Okay, so if I go back to kind of the household standard, we have a house, we have a mortgage on the house. Okay, we don't have an expense showing up for, there's no rent expense, because we have a house and we have a mortgage. So the mortgage payments go against the mortgage on the balance sheet. Okay, they don't show up as an expense on the profit and loss. So the critical part of understanding your cash flow is knowing that not every dollar that goes out on a profit and loss. It does also go out on the balance sheet. So we want to know, as accountants, we want to know, what is your debt to income ratio? Okay, if you've ever applied for a home loan, you understand what this is. What is your debt to income ratio? We call this the quick ratio. And it's one that we can pull up and talk to you about. Mine is very, very good. I have excellent debt to income because I don't mind leveraging. I don't mind borrowing money to make me money, but I do mind borrowing money to live on. So I don't tend to use my credit cards for much more than credit builder. Okay. I've gotten very cautious about that. So that's what you have to look at. And I keep bringing it up because I keep having clients that just completely misunderstand the difference. You can have more revenue than expenses and still have every penny of that revenue, that gross or the net profit, be earmarked for payment of liabilities, and that can still cause problems. So we look at the statement of cash flows because we want to know when you're running a business, we want to know how much of the financing of this business is due to operations. Okay, your business should be paying its own daily operational costs, unless you're a brand new startup or unless you're still being affected by 2020. Okay, there's a few scenarios where that might not be the case, and we're living in a very weird time. So there's a few times when that might not be 100% true. But for the most part, in general, your business should be financing itself, basically. You should not need to take out a loan every 2 weeks to pay payroll. You should not be taking out a loan to pay your rent. And I would say this not just in business, but individually, you should not be taking out loans to pay your operating expenses. Okay, what does it cost you to just live in your house and be happy? You know, you shouldn't be taking out loans for that. You should be taking out loans for. So when you back up a little bit, because my brain gets ahead of my mouth sometimes. So you should not be paying your operating expenses with loans, okay, unless you're in some very specific special circumstances. Your business should be generating enough revenue to cover its own operating expenses. Okay. So when do you take out a loan? When do you take out loans? Well, one is if you have a trade line. Okay, it's very convenient to be able to just tell them to put it on my account and pay that off every month. Yeah. And yes, you want to extend as long as you can. A lot of trade lines will give you it's called 210 financing, which means that if you pay within 10 days of the due date, you know, the end of the month. So if you have an end of the month cycle and you pay it before the 10th, you can take a 2% discount. That can add up pretty dramatically. Or you can I hate it when this happens. I know what I was going to say. You can take out loans. Okay, so you have the trade lines. I don't really think of trade lines too much as debt because it's really just postponing payment until you can pay it all at once at the end of the month. Okay. Also, you can take out loans to finance expansion and improvements. Okay, so in other words, this is a bit more than just operations. Like I said, with my client that opened the second location, if he had 100% committed to that second location and was determined to make it work and determined to, because he wasn't, he was against it from the beginning. It was his brother that wanted the second location. But if they had really committed to it, if they had really decided that come hell or high water, we're making the second location work, we're going to put all of our resources into making, not maintaining the first location, but into really growing the second location, then it would have been 100% acceptable for them to then finance the second location. So we look on the cost of good, or the cash flow statement, and we look and we see how much of the operating expenses were paid by operating income. Okay, 100% should be the answer, unless you're in a special circumstance. How much of the expenses of the business were paid by financing activities? This is requesting a loan, issuing bonds, issuing debt like that. Maybe issuing stock. Most of the clients that I work with are not going to be in that position because they're not publicly traded. If they were publicly traded, they couldn't work with me. But you could conceivably issue stock in exchange for some financing, okay? Or bonds. That's exactly what a bond is. It is, I will, pay you on Tuesday for a hamburger today. That's a bond. There's a number of ways to finance your business but they all involve taking on debt, okay? Whether it's stocks or bonds or that are generated by the company, or you just go out and pursue a business loan, an SBA loan, if you got an EIDL or PPP, and they have not been forgiven, then that goes under financing activities, okay? In fact, even if they have been forgiven, it goes under financing activities. The last way that you can develop or bring in money for your business is through investing activities. And my very next video is going to be talking about capital gains and about some political things that are being floated about capital gains. I want to really get into that today, but not in this video. So it'll be in a separate video today. So when you purchase a piece of equipment, let's say you bought a commercial oven for your commercial kitchen and you paid $1,000 for it. And let's say you took really, really good care of it, okay? And you used it for 5 years and then you decided to sell it. Well, there's a couple of things that are going to go into this. We are going to record that as a gain or a loss on the sale of assets, okay? So we're going to look and see how much has it been depreciated? What's the book value of it now? What did you actually sell it for? If your book value is less than your sale price, then you have a gain on the sale of your asset. If your book value is more than your sale price, then you have a loss on the sale of your asset. And this is all accounting mumbo jumbo. There's a lot that goes into figuring these, but we really want to look at how much depreciation has been taken since the purchase was made. What was the original cost basis? We want to know then how much did you sell it for? Let's say because you sold it, you took really super good care of it, you sold it for $500. Well, let's see, we've got over 5 years, it would have depreciated down to nothing. So it's a $500 gain on the sale of an asset, even though it's for less than the original cost basis, okay? So there's a lot more to it than that. That's an ultra simplified example, but that is another way that you can finance your business. You can sell old assets, okay? You can sell them for scrap, and that's a way of making investment income. You can purchase real estate and rent it out. There's a lot of ways that you can invest in your business that will show up under investing activities. So when we're looking at the statement of cash flows, we want to look and see how much is being also in investment. As if you, the owner, are putting money into the business, that's an investing activity, okay? So we want to know, how much did you put in? How much did you borrow? And how much did you take care of through operating expenses or through operating activities? These things are going to help you really have a handle on the cash flow of your business. Now, I have done 3 videos now on measuring what you want to manage. And that goes from everything from weight management in my personal life to money management. If you're paying attention to it and you're measuring it, you will be able to manage it better, okay? And that's, like I said, that's everything. If you're a heavy drinker and you decide you want to start monitoring your drink intake and you're marking off how many beers you had, pretty soon you start hoping not to mark quite as many off, okay? Because you're measuring it. The act of measuring it is a form of management. If you are trying to lose weight and you're keeping a food diary, pretty soon you don't eat as much because you don't want to write it down, and you have to write it down, you know. If you are working out and you're lifting weights and you're keeping track of how much weight, you're like, I'm a girl, so I'm going to say 100-pound bench press. And I used to do those. Well, then I'm going to start keeping track of today. I put 20 pounds on the bar and I did this many bench presses. Tomorrow, maybe after a week, I put 25 pounds on the bar or 30 and see how I do. But if I don't measure it, I might not remember from one week to the next what my goals were, what my personal best was. You have to measure it. So it's the same thing with cash flows. If you are looking at your statement of cash flows and you understand what it's telling you, which is where's the money coming from? It's a frequent question we ask our clients. Where'd the money come from? Okay. Then we want to know how much of your income has to go towards servicing your liabilities, servicing your debt. Okay. You can have, and I'm going to say this again, you can have a highly profitable business on paper and be upside down in your cash flow. And if that happens, you're going to have a very difficult time of it. We will help you, but it will be challenging to get out from underneath that because there's so much with business. You know, at home, we can postpone things as long as we can. At work, you know, at business, there's a limit because the last thing you want is for your business to have a reputation of maybe not paying people on time. You might want to then move paydays around. I just did this in my own business. Payday was Wednesday, and I was finding I was so overwhelmed on Mondays and Tuesdays that I couldn't get to payday on Wednesday. Wasn't about the money. The money was there, but I finally decided I'm moving payday to Friday. Okay, so that it's consistent every single week. Payday is Friday, so that I have time then to run payroll a few days in advance, so that I'm not scrambling on the day it's due or apologizing to employees about, oh, sorry. But, you know, that might be a cash flow thing too. If I know that I have most of my money coming in on Fridays, then of course I want payroll to go out on Friday. There's a lot of things that have to be looked at for that. So that's it about the cash flow statement for today. I'm going to talk a little bit more about other financial statements as we go along. And then I'm going to end this video so I can put up another video, and it will be about capital gains. As always, if you enjoy these videos, if I've said anything interesting or entertaining, please feel free to like, share, and subscribe. If you're on YouTube, hit the notification bell so you get notified when I upload a new video. I'm really looking forward to having some other people on this show. There's a lot. There's so much to be covered in the fields of accounting and bookkeeping and payroll and finance. There's just, you know, there's multiple degrees on it. So I am, you know, excited to share some of my knowledge and experience with you. If you hit the notification bell, if you like, share, subscribe, it helps me grow my channel. So maybe people that you don't even know can benefit from the information that I'm giving you. So if you think it's valuable at all, you know what to do. Thanks very much. Also, if you would, please give us a 5-star review on Google. Okay. Don't give us any 1-star reviews. If you think this is 1 star, you probably didn't get to the end of the video anyway. 3 stars is kind of wishy-washy. I know there's a lot I could do. I'm not a professional actress, and I don't have a professional videographer. This is just me in a room talking to a camera, talking to my monitor, you know. So, but hopefully the information that I'm giving you is solid information. So I'm looking forward to hearing from you. Please, I will talk to you again soon.